In this week's video, we'll review the latest charts to help us answer the question, the economy and markets, is this as good as it gets? We'll be moving quickly, so feel free to use the pause button on your video player. The big news this week came on Friday. Non-farm payroll report came in way above expectations, 254,000 jobs. And that's relevant because we know in cycles where the Fed is cutting rates and they tend to do so at a slow rate, meaning the economy isn't in major trouble, stock market performance looking out 1 to 2 years tends to be quite good historically. Chart in the lower right-hand corner of your screen, NASDAQ after the first cut in the slow cycle cases, 1980, 1984, 1995, and 1998. 2 years later, every time the NASDAQ was higher, the median gain, approximately 50%. Nothing in Friday's payroll report said recession. How about the charts? This is a daily chart of the S&P 500 spanning 9 months in 2021 and 2022. Moving averages range from the 20-day moving average in orange all the way out to the 200-day moving average in red. This is the type of rollover transition look that we want to avoid in 2024 and 2025, meaning it would be helpful to know what the same chart looks like spanning 9 months in 2024. The answer is it looks like a much stronger trend. This is midday after NFP was released on Friday, October 4th at 10 a.m. Eastern Time. Unlike January of 2022 here in the early stages of the 2022 drawdown and bear market, in the present day, on October 4th, 2024, we have a full-bore bullish look with the 20-day moving average, the fastest moving average in orange on top, the 200-day moving average in red on the bottom, prices above all the moving averages, and the slopes of all the moving averages are up. This looks significantly different from this period in here. And the better-than-expected payroll report on Friday was not particularly surprising when we reviewed market action as of the close on Thursday, the day before NFP. If the market were expecting a horrible labor report on Friday, that would basically say the Fed would be cutting rates in larger increments with a potentially lower interest rate target at the end of that cycle. That would be good for bonds. Were investors snapping up bonds during Thursday's session? They were not. IEF and IEI, two major bond ETFs, underperformed SPY and the S&P 500 significantly. Another fair question, were money managers migrating toward defensive stocks? Keep in mind, many money managers, especially mutual fund managers, have to stay fully invested. So if they're concerned, they can take a more defensive stance. XLP during Thursday's session also significantly underperformed SPY and the S&P 500. The daily chart that we covered previously was intraday when the S&P 500 was up 26 points. It finished significantly higher. It was up 50 points right before the close on Friday, October 4th. Heading back to the daily charts of the S&P 500, if you focus on this region here in January of 2022, you'll see the tight clustering look in here when the trend is rolling over. If we switch over to the left side of your screen, that's not what we've had in 2024. Resolution to the upside, resolution to the upside. And last time the same moving averages were clustered together, it resolved to the upside. You can see during Friday's session, all of the recent consolidation up here in late September, early October is occurring above this base here around 56.50. We closed well above that level on Friday, October 4th, closer to 57.50. The left side of the screen, this is the look that we wanted to avoid using the 20-day all the way out to the 200-day. That can also help us with leadership and relative performance. For example, if we swap out this chart on the right side and look at the relative trend during Friday's session on October 4th of small caps relative to SPY or the S&P 500, you can see the right side of your screen here looks a lot like this rollover look that we want to avoid. And one of the basic tenets of trading the chart in front of you is that we should avoid extrapolation. The ratio of small caps to the S&P 500 could improve significantly if it moves back into this region, and that's something that may happen soon. It just hasn't happened yet. Similar situation if we look at defensive staples, XLP, relative to SPY. This does have some similarities to this look over here, and this on the right side of the screen looks significantly different from the S&P 500 in isolation, a strong bullish trend. We also don't have anything on the equal weight S&P 500 relative to SPY that screams trend flip. All of this consolidation and sideways movement in recent months has been occurring below a downward sloping 200-day moving average. Once again, if this ratio can pop out into this area here, this 200-day can turn up, then it's possible that RSP is trying to lead relative to SPY. So the purpose of this chart, and this chart is to say small caps, defensive staples, and the equal weight S&P 500 really are still laggards from a trend perspective until proven otherwise. But while RSP may be struggling relative to SPY, we can also learn something when we see how sound and strong the trend looks in isolation. This is a clean, full-bore bullish look. This is a strong trend look, and it tells us that our laggards even look healthy. And that speaks to broad participation and healthy market breadth. That commentary applies to RSP in isolation. In the chart of IWM, small caps in isolation, shown on the right side of your screen, looks a lot better than that relative chart that we covered earlier. And the same can be said for defensive staples. Not particularly attractive when we look at the ratio of staples to the S&P 500, but in isolation, one of our laggards still has a healthy trend. All of this action up here in recent days and weeks is occurring above an upward sloping 50-day moving average in pink and well above an upward sloping 200-day moving average in red. If we go back to a ratio chart for XLP and this time examine XLP relative to SPY on a weekly time frame, here we have the 30-week moving average in blue, the 40-week in green, the 50 in pink, and the 200-week moving average in red. We can see during the week of NFP, intra-week at 2:29 p.m. Eastern Time on Friday, October 4th, defensive staples, again, underperforming for the week by almost 2%. We were above the moving averages down here, pink, green, and blue, and now we've popped back below. Also noteworthy, what once acted as support down here in 2021 may now act as resistance in 2024, and it appears that that's what's happened. We came back up into this area here, and thus far it looks like this ratio, a defensive ratio, is being rejected. This too aligns with the theme from this tweet, aligns with the bullish and recession avoiding NFP report that came on Friday, 254,000 jobs, well above expectations. And it would also align with a 25 basis point cut at the next Fed meeting and the potential to align with 1980, 1984, 1995, and 1998. 1 year later from the date of the first cut in these four cases, the average gain for the NASDAQ composite was just a hair under 39%. We've said numerous times, dating all the way back to Q4 of 2023, and numerous times in these weekly videos in 2024, that we don't want to get too cute. We don't want to become overly obsessive about trying to be invested in the leaders every single session, every single week, every single month, or even every single quarter. We're in a bull market, and the daily chart of the S&P 500 looks good. You can see price is above an upward sloping 20-day, an upward sloping 30-day, an upward sloping 40-day, an upward sloping 50-day, and above an upward sloping 200-day. We've also exceeded this high from July here and exceeded this bounce back high from August. Thus, all of this recent consolidation is occurring above this base. We've also seen some positive improvement in the Citigroup Economic Surprise Index, and Ed Yardeni makes a back-of-the-envelope case that the S&P 500 may be on course to rise above 8,000 by the end of the decade. If you get above 8,000, that's approximately a 40% gain from current levels. Everything that we've covered, including the look of this chart, says don't get too cute here. Do not overtrade. That's the exact same message from the CCM Model scores. Trend strength scores, 98 and 100. Secular volatility scores during the session on October 4th, 2024. Very favorable. And in terms of recent signals, Dean mentions we had a bullish upswing in price momentum. You can see there were numerous cases, these red dots dating back to the 1960s. 12 months later, the average gain in the S&P 500 equal weight 14%. 100% of these cases saw the equal weight index higher a year later. Jay, Twitter handle here, also at Sentiment Trader. Notice the recent monthly pattern in the S&P 500 also tended to precede very impressive returns. The S&P 500, standard S&P 500, 12 months later, in each of these red dot cases, historically going back to roughly 1950 here, the average gain 12 months later in the S&P 500, 20%. Again, every single case higher. We're still in a situation where bullish trends remain in place. Leadership, not as clear. Still leaning towards tech and growth, but there's some indecisiveness in that story, and that's not necessarily a bad thing. That speaks to broad participation. Regardless of the relative charts, the isolation charts look good. Patience tends to work extremely well in bull markets, and we're currently in a bull market. As always, the commentary in this week's video is based on the charts and data in front of us. We're not making any assumptions about what Monday will look like, or what the next 3 weeks will look like, or what the next 3 months will look like. And we all know, to do that effectively, we have to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.